The world is changing. Technology is advancing at an unprecedented rate, reshaping industries and our daily lives. From the way we communicate to the way we conduct business, the digital revolution is transforming our world. One of the most significant innovations to emerge from this revolution is cryptocurrency, a form of digital currency secured by cryptography. At the forefront of this new financial frontier is Bitcoin. Bitcoin is a decentralized digital currency, operating independently of any central bank or government control. It exists solely as a digital asset, recorded on a distributed ledger called a blockchain. This groundbreaking technology ensures transparency, security, and immutability, making Bitcoin transactions resistant to censorship and fraud. As a global currency, Bitcoin transcends geographical boundaries, offering fast, low-cost transactions across borders. Bitcoin's emergence has sparked a wave of innovation, paving the way for a new era of finance. Its decentralized nature challenges traditional financial systems, offering individuals greater control over their assets and financial freedom. The potential impact of Bitcoin on the global economy is immense, with experts predicting a significant shift in the way we think about and interact with money. Since its inception in 2009, Bitcoin has captured the attention of investors, entrepreneurs, and governments worldwide. Its value has fluctuated dramatically, experiencing periods of rapid growth and market corrections. Despite its volatility, Bitcoin has consistently demonstrated its resilience, recovering from downturns and reaching new all-time highs. This volatility, however, underscores the importance of understanding the underlying technology, market dynamics, and potential risks associated with this emerging asset class. In this exploration of Bitcoin, we will delve into its history, examining its origins, the technology that underpins it, and its potential impact on the future of finance. We will explore the intricacies of Bitcoin mining, the process by which new Bitcoins are created and transactions are verified. Furthermore, we will discuss the concept of halving, a pre-programmed event that reduces the rate of Bitcoin issuance, influencing its scarcity and value over time. Understanding the broader cryptocurrency market is crucial to grasping Bitcoin's place within this evolving ecosystem. We will delve into market cycles, exploring the factors that drive market sentiment and price fluctuations. Geopolitical events, technological advancements, and regulatory developments all play a role in shaping the cryptocurrency landscape. By examining historical trends and expert analyses, we aim to provide insights into the potential trajectory of Bitcoin and its impact on the global financial system. This exploration of Bitcoin is intended for educational purposes only and should not be construed as financial advice. Investing in cryptocurrencies carries inherent risks, and it is essential to conduct thorough research, understand the market dynamics, and consider your own financial circumstances before making any investment decisions. Bitcoin's story begins in the depths of the 2008 financial crisis. As traditional financial systems teetered on the brink of collapse, a profound distrust in centralized institutions began to grow. It was in this climate of uncertainty that a pseudonymous individual, or group of individuals, under the name Satoshi Nakamoto, introduced Bitcoin to the world. On 31st October 2008, Satoshi Nakamoto published the Bitcoin White Paper, a groundbreaking document outlining a vision for a peer-to-peer electronic cash system. This white paper, titled Bitcoin, a peer-to-peer electronic cash system, laid the foundation for a decentralized digital currency, free from the control of governments and financial institutions. It proposed a system where transactions could be conducted directly between parties without the need for intermediaries, using cryptography to secure the network and verify transactions. This revolutionary concept challenged the very foundations of traditional finance, promising greater transparency, security, and financial freedom. The Bitcoin network officially launched on 3rd January 2009 with the mining of the first block, known as the Genesis block. This marked the birth of Bitcoin and the beginning of its journey to disrupt the global financial landscape. Embedded within the Genesis block was a message. The Times, 03 Jan 2009. Chancellor, on brink of second bailout for banks. This time-stamped message served as proof that the block was mined after that date, preventing any manipulation of the blockchain. It also alluded to the motivations behind Bitcoin's creation, a desire to create a financial system outside the control of governments and central banks. The identity of Satoshi Nakamoto remains one of the most enduring mysteries in the world of technology and finance. To this day, no one knows for sure who Satoshi Nakamoto was, or whether it was a single person or a group of individuals. Despite numerous attempts to uncover their identity, Satoshi Nakamoto vanished from the online world in late 2010, leaving behind a legacy that continues to shape the future of finance. Their disappearance only adds to the mystique surrounding Bitcoin, fueling speculation and intrigue. Satoshi Nakamoto's contributions to the development of Bitcoin were significant. They not only conceived the original idea, but also designed the initial architecture of the Bitcoin network and its underlying technology. They actively participated in online forums, engaging with early adopters and developers, answering questions and refining their vision for Bitcoin. Their deep understanding of cryptography, computer science, and economics is evident in the elegant design of the Bitcoin protocol. Despite their anonymity, Satoshi Nakamoto's impact on the world is undeniable. They created a revolutionary technology that has the potential to reshape the global financial system. Their work has inspired countless entrepreneurs, developers, and investors to join the cryptocurrency revolution, driving innovation and challenging the status quo. The mystery surrounding their identity only adds to the allure of Bitcoin, cementing its place in popular culture. To understand Bitcoin's origins fully, one must delve into the world of cryptography and the cypherpunk movement. The cypherpunks were a loosely organized group of activists and cryptographers who emerged in the late 1980s and early 1990s. They believed in the power of cryptography to protect individual privacy and promote freedom of speech in the digital age. They saw the potential for cryptography to empower individuals and challenge the growing surveillance powers of governments and corporations. Satoshi Nakamoto's work on Bitcoin drew heavily from the ideas and technologies developed by the cypherpunk movement. Many of the concepts central to Bitcoin, such as decentralized consensus mechanisms, public key cryptography, and digital signatures, had their roots in the work of cypherpunk pioneers. Bitcoin can be seen as a culmination of decades of research and experimentation by cypherpunks, who envisioned a future where individuals had greater control over their data and finances. The cypherpunk ethos of privacy, individual empowerment, and distrust of centralized authority is deeply embedded in Bitcoin's DNA. Bitcoin's decentralized nature reflects the cypherpunk belief that power should be distributed rather than concentrated in the hands of a few. The use of strong cryptography ensures the security and immutability of the Bitcoin network, protecting it from censorship and manipulation. Bitcoin's emergence can be seen as a testament to the enduring legacy of the cypherpunk movement and its vision for a more private and decentralized future. At the heart of the Bitcoin network lies a process called mining. It is the engine that powers Bitcoin, ensuring its security and enabling the creation of new Bitcoins. In essence, Bitcoin mining is a decentralized process where powerful computers compete to solve complex mathematical problems. These problems are designed to be computationally intensive, requiring significant processing power and energy consumption. The first miner to solve the problem gets to add a new block of transactions to the Bitcoin blockchain. This process is known as proof of work, or POW, and it serves several crucial purposes. Firstly, it ensures the security of the Bitcoin network. By requiring miners to expend real-world resources, electricity, and computing power, POW makes it extremely difficult and costly for any single entity to gain control of the network. Any attempt to tamper with the blockchain would require controlling a majority of the network's hash rate, which is highly improbable due to the distributed nature of mining. Secondly, mining is how new Bitcoins are introduced into circulation. When a miner successfully adds a new block to the blockchain, they are rewarded with a predetermined number of newly minted Bitcoins. This reward known as the block reward, is the incentive that motivates miners to participate in the network and contribute their computing power. It is through this process of mining that the Bitcoin supply is gradually increased over time, following a predetermined schedule. One of the most remarkable features of Bitcoin is its limited supply. Unlike traditional fiat currencies, which can be printed endlessly by central banks, Bitcoin has a fixed maximum supply of 21 million coins. This scarcity is hard-coded into Bitcoin's protocol and is achieved through a process known as the halving. The halving is a pre-programmed event that occurs approximately every 4 years, reducing the rate at which new Bitcoins are created. When Bitcoin first launched, the block reward for miners was 50 Bitcoins per block. Every 210,000 blocks mined, roughly equivalent to 4 years, this reward is cut in half. The first halving event occurred in 2012, reducing the block reward to 25 Bitcoins. The second halving happened in 2016, bringing the reward down to 12.5 Bitcoins. The most recent halving took place in May 2020, further reducing the reward to 6.25 Bitcoins per block. This halving mechanism is crucial to Bitcoin's economics and long-term value proposition. By consistently reducing the rate of new Bitcoin creation, the halving ensures that Bitcoin remains a scarce asset. This built-in scarcity is one of the key factors driving Bitcoin's value proposition, as demand continues to grow while supply remains constrained. The halving events are highly anticipated by the Bitcoin community and are often associated with periods of increased market activity and price volatility. The security of the Bitcoin network is paramount to its functionality and trustworthiness. As a decentralized system, Bitcoin relies on a distributed network of computers, known as nodes, to maintain its integrity. These nodes work collaboratively to validate transactions, prevent fraud, and ensure the overall health of the network. The process of mining plays a critical role in securing the Bitcoin network by making it computationally infeasible for any single entity to take control. Miners, with their significant computing power, act as the guardians of the blockchain. By competing to solve complex mathematical problems, they contribute to the security of the network in several ways. Firstly, the proof-of-work mechanism ensures that any attempt to alter past transactions would require an attacker to redo the work of all subsequent blocks, which is practically impossible given the current hash rate of the network. Secondly, the decentralized nature of mining makes it highly resistant to censorship. With miners distributed globally, no single government or organization can shut down the Bitcoin network. Even if a significant portion of miners were to be taken offline, the remaining miners would continue to validate transactions and secure the network. This resilience is one of Bitcoin's key strengths, making it an attractive alternative to traditional financial systems that are susceptible to censorship and control. Bitcoin, often referred to as digital gold, holds a unique position within the broader cryptocurrency market. It was the first cryptocurrency to gain widespread adoption and remains the largest by market capitalization. However, the cryptocurrency landscape has expanded significantly since Bitcoin's inception, evolving into a diverse ecosystem of digital assets. Thousands of cryptocurrencies, known as altcoins, have emerged, each with its own unique features and value propositions. These altcoins encompass a wide range of projects, from stablecoins pegged to fiat currencies to decentralized finance, or DeFi, applications offering financial services on the blockchain. Understanding the differences between Bitcoin and altcoins is crucial for navigating the cryptocurrency market. While some altcoins aim to improve upon Bitcoin's technology or offer additional functionalities, others serve entirely different purposes within the crypto ecosystem. This diversity within the cryptocurrency market presents both opportunities and challenges for investors. On the one hand, the emergence of new and innovative crypto projects offers the potential for significant returns. On the other hand, the sheer number of cryptocurrencies can be overwhelming, and it is essential to conduct thorough research before investing in any digital asset. It is also important to remember that the cryptocurrency market is highly volatile. and investments can fluctuate significantly in value. Bitcoin's price history has been characterized by periods of rapid growth, followed by sharp corrections. These cyclical patterns, often referred to as market cycles, are influenced by a complex interplay of factors, including market sentiment, technological advancements, and regulatory developments. Understanding these cycles is crucial for investors seeking to navigate the volatility of the cryptocurrency market. One of the most well-known models for understanding Bitcoin's market cycles is the 4-year cycle theory. This theory suggests that Bitcoin's price movements are influenced by the halving events, which occur approximately every 4 years. According to this theory, Bitcoin typically experiences a bull market in the year following a halving, as the reduction in new supply puts upward pressure on the price. However, it is important to note that this theory is not without its critics, and Bitcoin's price movements are not always predictable. Market cycles can be influenced by a wide range of external factors, such as macroeconomic conditions, geopolitical events, and regulatory changes. Furthermore, as the cryptocurrency market matures, these cycles may become less pronounced or take on different characteristics. Therefore, it is crucial to approach any investment decisions with caution and not rely solely on historical price patterns. Market sentiment, the overall attitude of investors towards a particular asset or market, plays a significant role in driving price fluctuations in the cryptocurrency market. Bitcoin, being the most established and widely traded cryptocurrency, is often seen as a bellwether for the broader market. When investors are optimistic about the future of Bitcoin, demand for the cryptocurrency tends to increase, driving up its price. Conversely, negative sentiment can lead to sell-offs and price declines. Several factors can influence market sentiment, including news events, technological developments, and regulatory announcements. Positive news, such as the adoption of Bitcoin by major institutions or the implementation of favorable regulations, can boost investor confidence and drive up demand. On the other hand, negative news, such as security breaches, regulatory crackdowns, or macroeconomic uncertainty, can lead to fear, uncertainty, and doubt, often referred to as FUD, resulting in price corrections. It is important to note that market sentiment can be highly subjective and influenced by a variety of factors, including social media trends, influencer opinions, and even market manipulation. As such, it is essential for investors to approach market sentiment with a critical eye and not make investment decisions based solely on short-term fluctuations in sentiment. A well-informed investment strategy should be based on a thorough understanding of the underlying technology, market fundamentals, and individual risk tolerance. Bitcoin, by its very design, transcends national borders. It operates on a global, decentralized network, free from the control of any single government or institution. This inherent characteristic makes Bitcoin particularly sensitive to geopolitical events and macroeconomic trends that impact the global financial system. While traditional assets often find refuge in specific national economies during times of crisis, Bitcoin's safe haven status is debated, as its value can be influenced by global uncertainty. Geopolitical events can impact Bitcoin in various ways. Political instability, economic sanctions, and trade wars can all contribute to volatility in traditional markets, potentially leading investors to seek alternative assets like Bitcoin. For instance, during periods of currency devaluation in countries facing economic turmoil, Bitcoin has emerged as an alternative store of value, particularly in countries with limited access to traditional financial services. Moreover, government policies and regulations surrounding Bitcoin can significantly impact its price. Positive regulatory developments, such as the adoption of clear legal frameworks for cryptocurrencies, can instill confidence in investors and drive adoption. Conversely, negative regulations, such as bans or restrictions on Bitcoin trading, can have the opposite effect, leading to uncertainty and price declines. The evolving regulatory landscape around the globe continues to be a significant factor influencing Bitcoin's price trajectory. The question of whether Bitcoin is a safe haven asset akin to gold, or a speculative investment, is a topic of ongoing debate. Proponents of the safe haven narrative argue that Bitcoin's decentralized nature, limited supply, and resistance to censorship make it an attractive hedge against inflation and economic uncertainty. They point to historical instances where Bitcoin's price has surged during times of geopolitical instability, such as the Greek debt crisis and the Cyprus banking crisis. However, critics argue that Bitcoin's volatility and relatively short track record make it a risky investment and a poor hedge against traditional market downturns. They point out that Bitcoin's price can be influenced by factors unrelated to global events, such as regulatory changes, technological advancements, and market sentiment. Furthermore, Bitcoin's correlation with other risk assets, such as stocks, has led some analysts to question its safe haven status. Ultimately, whether Bitcoin acts as a safe haven or a speculative asset likely depends on a confluence of factors, including the specific geopolitical or economic event, investor sentiment, and market dynamics. As Bitcoin continues to mature and gain wider adoption, its role in the global financial system may become clearer. However, for now, investors should exercise caution and understand that Bitcoin's price can be influenced by a complex interplay of factors, both predictable and unpredictable. Examining specific case studies can provide valuable insights into how geopolitical events have impacted Bitcoin's price in the past. One such example is the Cyprus banking crisis of 2013. Faced with a severe financial crisis, the Cypriot government imposed a levy on bank deposits, including those held by foreign citizens. This unprecedented move shook investor confidence in the traditional banking system and led many to seek alternative assets, including Bitcoin. As a result, Bitcoin's price surged during this period, highlighting its potential as a safe haven asset in times of financial turmoil. Another notable example is the period following the UK's decision to leave the European Union in 2016, commonly known as Brexit. The uncertainty surrounding the UK's departure from the EU led to volatility in global markets, including a sharp decline in the value of the British pound. During this time, Bitcoin's price experienced a significant increase as investors sought to hedge against the perceived risks associated with the UK's economic future. More recently, the COVID-19 pandemic and the subsequent global economic downturn have also had a notable impact on the cryptocurrency market. Bitcoin's price initially plummeted in early 2020 alongside other risk assets as the pandemic spread globally and governments implemented lockdowns. However, Bitcoin quickly recovered and went on to reach new all-time highs later that year, as governments and central banks around the world injected trillions of dollars into the financial system, raising concerns about inflation. These real-world examples demonstrate the intricate relationship between geopolitical events and Bitcoin's price, highlighting its potential as a hedge against traditional market volatility, while underscoring its susceptibility to global uncertainty. The cryptocurrency market, while maturing, remains highly susceptible to unforeseen global events. These events, often termed black swan events, are unpredictable and can have a significant impact on financial markets, including Bitcoin. Natural disasters, pandemics, political upheavals, and major technological disruptions can all fall under this category. The interconnected nature of the global economy means that such events can send ripples across markets, impacting investor sentiment and asset prices. For Bitcoin, these events can trigger both positive and negative price movements. On the one hand, periods of global uncertainty can drive investors towards alternative assets like Bitcoin, perceived as a hedge against traditional market volatility. This was evident during the early stages of the COVID-19 pandemic, where Bitcoin's price initially fell, but quickly rebounded, even exceeding previous highs. This surge was partially attributed to investors seeking refuge from the instability of traditional markets. On the other hand, unforeseen events can also trigger sell-offs in the cryptocurrency market. Investors may choose to liquidate their digital assets to access cash during times of economic hardship or uncertainty. Furthermore, negative news surrounding Bitcoin, such as regulatory crackdowns or security breaches, can amplify the impact of these events on its price. Understanding the potential influence of black swan events requires investors to stay informed about global developments and assess their potential implications for the cryptocurrency market. Technological advancements play a crucial role in shaping the trajectory of Bitcoin and the broader cryptocurrency market. Bitcoin itself was born out of technological innovation, leveraging cryptography and decentralized consensus mechanisms to revolutionize financial transactions. As technology continues to evolve, new opportunities and challenges emerge, impacting Bitcoin's adoption, security, and overall value proposition. One significant technological development is the ongoing research and development in blockchain scalability. Currently, Bitcoin's transaction throughput is limited by the design of its blockchain, which can lead to slower transaction speeds and higher fees during periods of network congestion. Solutions like the Lightning Network, a Layer 2 payment protocol built on top of Bitcoin, aim to address these limitations by enabling faster and cheaper transactions. The successful implementation of such technologies could enhance Bitcoin's utility for everyday payments and drive further adoption. Furthermore, advancements in quantum computing pose both potential threats and opportunities for Bitcoin. While quantum computers could potentially compromise some of the cryptographic algorithms underpinning Bitcoin's security, research is also underway to develop quantum-resistant cryptography that could enhance Bitcoin's long-term security. As technology continues to evolve, it is essential to monitor these advancements and assess their potential implications for the future of Bitcoin and its underlying infrastructure. Investor sentiment, the overall attitude of the market towards Bitcoin, is a powerful force that can significantly impact its price movements. Positive sentiment, often driven by factors like positive news coverage, institutional adoption, or technological advancements, can lead to increased demand and price appreciation. Conversely, negative sentiment, fueled by events like regulatory uncertainty, security breaches, or macroeconomic downturns, can trigger sell-offs and price corrections. Understanding the drivers of investor sentiment is crucial for navigating the cryptocurrency market. News and media coverage play a significant role in shaping public perception and influencing investment decisions. Positive news flow, such as major companies adding Bitcoin to their balance sheets or governments implementing favorable regulations, can create a FOMO, fear of missing out effect, driving up demand and prices. On the other hand, negative news, such as security breaches, regulatory crackdowns, or prominent individuals expressing skepticism about Bitcoin, can lead to FUD, fear, uncertainty, and doubt, triggering sell-offs and price declines. It's important to note that investor sentiment can be highly subjective and susceptible to manipulation. Furthermore, social media platforms have emerged as powerful amplifiers of sentiment, rapidly spreading both positive and negative information, often with little regard for accuracy. Therefore, it is crucial for investors to approach market sentiment with a critical eye, verify information from reliable sources, and make investment decisions based on thorough research and their own risk tolerance. As we conclude this exploration of Bitcoin, it's crucial to remember that the insights shared here are for informational purposes only and should not be misconstrued as financial advice. The world of cryptocurrency is complex, constantly evolving, and inherently risky. However, this deep dive into Bitcoin's history, technology, and the factors influencing its price provides a foundation for understanding this revolutionary technology's potential impact on the future of finance. From its humble beginnings as a cypherpunk dream to its current status as a globally recognized digital asset, Bitcoin has challenged conventional notions of currency, finance, and the very nature of money. Its decentralized design, fueled by cryptography and driven by a global community, continues to disrupt traditional financial systems, offering an alternative vision for a more open and accessible financial future. Whether Bitcoin ultimately becomes a dominant global currency or remains a niche asset class is a question that only time will tell. However, one thing is certain. Bitcoin's emergence has sparked a wave of innovation, leading to the development of blockchain technology and countless other cryptocurrencies. This technological revolution is transforming various industries, from finance and supply chain management to healthcare and digital identity. As we move forward, it is essential to approach this evolving landscape with a balanced perspective, recognizing both the opportunities and challenges presented by Bitcoin and the broader cryptocurrency market. By fostering a deeper understanding of these technologies, we can navigate this new frontier responsibly and contribute to shaping a more equitable and innovative financial future for all.